Good evening to everybody. We are starting now our recording. It's the first webcast that we ever done, so be patient. And there is no better kind of speakers to introduce us to the community bank experience than Bridget Meehan and Paul Gosling. Thank you both for participating. Bridget is the voice and the face behind the campaign for a community bank in Northern Ireland. And Paul has been interested in the cooperative movement as a journalist, but also as a cooperative developer, but also as an insightful observer of what was happening with the cooperative bank. As an author of his interesting book, The Fall of the Ethical Bank, he will describe what he has learned through that experience. Now, Bridget has started the campaign on Community Bank a couple of years ago, but we met only recently, and this campaign is getting some kind of impetus. So we will hear where the campaign is and what Bridget has done so far.
Just in a nutshell, community banking is an alternative approach to banking as we know it, and it moves us away from the privatised system that exists now and towards a democratised system that gives each of us a say in how our money can be used for our benefit and the benefit of our region. And the Our Money campaign exists to establish a community bank here in Northern Ireland and in the north of Ireland. And a lot of the time, this region feels like it's on life support, really. We're all too familiar with the problems. We have high levels of economic disadvantage and unemployment. Our social security system and public services have been cut to shreds with years of austerity. The real value of our incomes has fallen. Business closures and job losses have been widespread. And personal debt, including mortgage debt, has exploded. So this is all before we even get to think about the, global warming and the climate crisis, or even the current COVID-19 emergency. And there's a general sense that these problems are really beyond our control and that we're powerless to do anything to address them ourselves. The dominant narrative tells us that we're completely dependent on the annual payment of the block grant and that we have no money or resources of our own. And just about the only solution that the great and the good have for solving our problems is foreign direct investment. But that narrative isn't quite accurate. Our region has an ample supply of money. So for example, it's estimated that there's a total of about 1.48 billion of net deposits in the current accounts of SMEs alone. And on top of that, there's personal current accounts and savings from just ordinary people, as well as current accounts of public bodies. So there's quite a lot of money there. And the problem is that that money is invested in private banks. It's lodged there, it's staying there, and it doesn't really do much for our local region. It doesn't stay here to be invested here. There's really a need for, instead, most of it goes outside the region and invested elsewhere for the benefit of people who don't even live here. So there is a need for a mechanism that democratises our money and allows us to retain and recycle that ample supply of money that we generate here, and to match the demand for money with the supply. And the community bank is exactly the kind of mechanism that would allow us to do that. So the community bank, being set up as a mutual cooperative, is governed by principles and rules that are very, very different from those governing private banks. So for example, the community bank is established in a single geographical region, and it has to operate within that region only and serve the needs of the people in that region and the local economy. Unlike private banks that can operate and be set up anywhere and operate really anywhere across the globe. And the money that's deposited in the community bank is loaned out to the local economy and nowhere else. So that makes sure that the money that we generate here is recycled back in. Community bank is also owned and controlled by its customers, who become member owners by buying at least one share. And members, the only condition of being a member is that you live in the local region. So regardless of your financial means, you can't be refused membership. So that actually promotes financial inclusion. Each member then has one vote when it comes to decision making, and that's regardless of the number of shares they have. Members elect a board who run the bank and answer to them. So there's no faceless, unaccountable shareholders that live outside the region. And the community bank isn't profit driven, and doesn't have incentive structures like bonuses or excessive salaries. And again, this is a different approach from what we normally expect and see with private banks. Community banks too can prioritise lending to small businesses and business startups, especially worker and consumer co-ops. And this is very important because small businesses here employ over 400,000 people and have a turnover of about £45 billion. And the private banks actually are more focused on bigger business rather than small business. So there is a need to have some focus on small businesses. The community bank can prioritise economic sectors too, that add social and environmental value, such as renewable energy or zero waste management. And this is the kind of thing that would assist in mitigating against the climate crisis and help the region build a bit of resilience and sustainability. So the community bank is capable of fulfilling all of these kind of functions that really aren't happening at the minute with the private sector. And some people might think that's all a bit too far-fetched or too good to be true. The idea of having a bank that's driven by the needs of ordinary people and the real economy, rather than being driven by profits and the needs of wealthy investors who contribute very little to the real economy. Why does that seem too good to be true? And why does the very notion that we could have an institution that looks out for the interests of ordinary people and the real economy at a local level so far-fetched? And I think we're so accustomed to globalization, to corporations, and to seeing profits gravitate towards a small percentage of the population. Sometimes we're kind of cynical when we're told that there's another way to organize our economy and our society, that that there is an alternative. Whether it seems too good to be true or not, the truth is it is possible. And that's thanks to the Community Savings Bank Association, the CSBA, who have developed a model for setting up a community bank. They call it the bank in a box model. And this model has everything you need to set up the bank, from the licensing process with the Bank of England, to the financial modelling that needs to be done, to agreements with key suppliers, to cutting-edge banking software, and approval from the Prudential Regulation Authority and the Financial Conduct Authority. So it has everything that's needed. And using this model, a local region has two things to do. It has to set up a steering group that can drive and manage the project of getting the whole thing established. And it has to raise investment capital of £20 million. Now, our campaign so far is well on the way to forming the steering group. The campaign's been assisted and in partnership with Tiziana in Cooperative Alternatives. So we're working together, and in the past 6 months or so, Tiziana, we've managed to pull together most of the people that we'd need for the steering group. When we get the steering group formed, then we will kind of have a public face to the campaign where we can begin to raise the £20 million that is needed. And I want to stress the point too that the model can be tailored to meet the specific needs of a region. So for example, here in the north, it can be tailored to complement and not compete with the credit unions, to work in partnership with them, which is vital given how strong and vibrant that movement is here in the north. So there's already campaigns in Britain using this same model that are well underway. There's a campaign in Greater London, in Gloucestershire, in Devon, in Wales, Newcastle on Tyne, Liverpool, Greater Manchester. And so in all of these regions, people are seeing the value of and the potential of community banking. So we're not alone, and we're not starting from scratch, and we're convinced, as are CSBA and all the other people involved in the campaigns in Britain, that community banking is part of a solution to many of our economic, social and environmental challenges.
Thank you very much, all of you. As Tiziana has said, I'm the author of this book here. Where are we? There we are. And It's a story that's the opposite of Bridget's story, because whereas Bridget has given a positive presentation about what is possible, I'm giving a negative presentation of what can go wrong. And I often say, although I don't speak Greek, this is a story of hubris and nemesis. It's a story about the fact that, yes, you should be positive, you should be optimistic, but equally, you need to be realistic about the dangers, the risks, and take a sensible approach to managing any type of community banking operation. This is the story about the collapse of the cooperative bank. It might be unreasonable to call it a collapse because it is still trading, but the organization that is trading today is very different from the one that actually went into meltdown in 2008, 2009. Now, largely, the bank went down because of the merger with the Britannia Building Society. But essentially, it was a story of the chief executive of the cooperative group, Peter Marks, who was a very dominant figure within the organization. And that, as you might recognize, is the antipathy of what a cooperative should be. You shouldn't have a very dominant, powerful chief executive. You should have someone that's willing to work with other people. He came from the United Cooperative organization, which merged with the Cooperative Wholesale Society and formed the Cooperative Group. And although he was, if you like, the chief executive, the junior partner in that merger, he made himself the chief executive of the merged body as a condition of that merger going through. And that is a tale that we'll see again in the story. Now, Peter's view was that you had to have scale. He was convinced that the future of the cooperative movement, and he saw himself as the savior of the cooperative movement, he saw his role as creating scale. And his view was you shouldn't be in a sector unless you had a really significant scale of operation in that sector. That drove the merger of the cooperative retail movement with the Summerfield Group. And actually taking over the Summerfield Group was pretty well destroying much of the base of the cooperative retail sector, because the organization, while chasing scale, took over a portfolio of businesses that had the wrong footprint. They were too big for the type of movement, retail sector that the cooperative retail organization was going into. So he took over a portfolio of stores that didn't fit with his operation, and also he paid for it with debt that created a really big challenge for the organization to pay. Now, in a sense, that's a side story, but actually it's an important side story because it was very similar to what happened when the Cooperative Bank, which was a subsidiary of the Cooperative Wholesale Society, or the Cooperative Group rather, as it was by that time. Although it was a subsidiary, it was very much under the control and dominant influence of Peter Marks as the chief executive of the parent organization, the Cooperative Group. Now, he saw Cooperative Bank as being something that was just too small. It was very useful for the cooperative group. It created large, significant profits for the group, but it wasn't actually one of the big players. And he wanted to be able to compete with the big banks like the Royal Bank of Scotland and others of that type, Barclays and so on, whereas the cooperative bank was really quite a small operator. And he saw the merger with the Britannia Building Society as something that gave them both sides and also the opportunity to cross-sell between different financial bits of the industry, so that they were strong in insurance and they were strong in banking, but they weren't strong in mortgages. And with the merger with the Britannia Building Society, it gave them the opportunity to actually move into the mortgage market and gave them extra scale in terms of branch banking. In a way, that's an odd thing to have done, because at that point, most of the banks recognized that actually branches were a liability, not an asset. And so while most of the banks were going in a different direction, they were trying to split banking and insurance. They were trying to reduce their branch portfolio. The acquisition, as it was basically, of Britannia went in exactly the opposite direction to what the rest of the industry was doing. Now, you'd think that was a silly move, but the directors, because Peter Marks was so dominant, accepted his very strong advice that this is what they should do. Now, the interesting thing about the Britannia Building Society is that although the directors of the cooperative bank thought they were buying a really good asset, the regulator thought they were rescuing a failing organization. And essentially, it was something that needed to be rescued. but the directors were unaware of that. The regulator failed to tell them that. And so the regulator was happy that the cooperative bank, an apparently strong organization, would rescue a building society that was in crisis. And so you had this misunderstanding between the regulator and the board of the bank. You had a dominant chief executive of the organization of the retail side, who very strongly, too strongly really, influenced the management of the bank. And you had essentially a successful bank that rescued a failing building society. Now, you'll remember I said earlier that Peter Marks was the chief executive of United Co-ops, which was merged with the Cooperative Wholesale Society to form the Cooperative Group. And although he was the chief executive of the minor organization, he became chief executive of the major organization because he said that was the way the merger would go through. Well, guess what happened with Britannia Building Society? Although it was a failing body, the chief executive of that organization, Neville Richardson, made it clear that the merger could only go ahead if he became chief executive of the merged organization, the new expanded cooperative bank. And the regulator, surprisingly, even though they knew Britannia was a failing organization, accepted that. The board of directors of the cooperative bank didn't understand it was a failing organization, so they thought they were getting a good deal, but they weren't. Now, so you've got a lack of understanding, a lack of knowledge, and a lack of challenge on the board of the cooperative bank. You then had the chief executive of a failing organization taking over the merged organization, which was going in exactly the opposite direction of the rest of the industry by taking on the more building assets, the bank branches, and actually trying to merge together insurance with banking, which elsewhere was recognized was not working. And guess what happened? The thing didn't work. So this isn't really any surprise, but there's another element to this failure, which was the fact that you're supposed to have something called due diligence when you have a big merger or acquisition. Now, the due diligence was passed over by the cooperative bank to KPMG, the accountancy firm. But the fact that the due diligence didn't throw up the problems wasn't the fault, really, of KPMG, because the co-op bank told KPMG not to worry about one bit of the bank. And the bit of the building society, the bit that the KPMG didn't look into at Britannia Building Society was the lending portfolio to businesses. And that was the bit that as soon as the 2008-2009 financial crash happened, was the bit that went sour within the Britannia Building Society. So there wasn't proper due diligence taken. If there had have been, they wouldn't have gone through with it. And the chief financial officer of the cooperative bank, a man called Barry Tootle, was the person that subsequently regulators blamed for the lack of due diligence, the lack of understanding. The truth was that actually the leadership of the bank and the leadership of the cooperative group didn't want to find anything wrong, so they didn't look for it. And in fact, this was a groundbreaking merger. Until a short while before that, it wouldn't have been possible for this two types of mutual organization to have merged. And it was only possible because of a change in law, which was actually led by Mutuo with the backing of the cooperative group, which enabled that merger to take place. Now, you have to ask why they wanted to do that. And it did seem to me that the drive towards achieving this put all the intelligence to one side. So basically, they became so determined to get this done, they ignored common sense, which should have told them not to do it. So a lot of these things are just very strange. I could actually add that there was also, after the merger, a bit of financial misreporting. The cooperative bank misreported its capital position, which was actually weaker than was allowed. So you've got all these problems about poor financial reporting practice, poor quality of management, poor leadership, but above all, probably a lack of challenge by the directors of the cooperative bank over the people that were telling them what to do. And that's, I think, a message that should apply across to the whole of the mutual and charitable sector, the voluntary sector more generally. You have to have directors that are prepared to challenge and not to worry about appearing nasty or whatever. You have to challenge. So broadly, I think, Tiziana, that's the story. The
Yeah.
punchline to this is that while all this was going on, the thing that brought down the bank was the 2008-9 crisis, because what was it? The old investor, was it Warren Buffett, who said, "It's when the tide goes out, you can see who's been swimming naked." And the truth was that when the 2008-2009 financial crash came, a lot of organizations that weren't underlying viable but could get by on cash flow could no longer do so, because ultimately you lost your cash flow, and then the underlying strength of the business would show through. And that's what happened. That coincided with the point at which, still further, Peter Marks was believing it had to have bigger scale still. This was basically an organization that was already bust, but Peter Marks was determined that this was going to be a bank that genuinely could compete with Barclays and Royal Bank of Scotland. And the reason why I would do that was taking over a chunk of Lloyds Bank, one of the biggest banks in the UK, but one that had been really destroyed by not only the 2008-2009 financial crash, but also the fact that Gordon Brown had recognized that Halifax Bank was about to collapse, and he wanted that rescued. And the way to rescue it was to get Lloyds taking over. And in the process, Lloyds basically collapsed pretty well. It got rescued with 40% share taking over by the UK government, but it needed to be rescued because it had taken over Halifax. Took over Halifax. Of course, Gordon Brown wanted that to happen because he was determined that Halifax wouldn't go down. Then Lloyds was under threat, and because of the requirements on state aid, it had to get rid of a large chunk of its bank branches. Now, you remember that actually the rest of the industry by this time was actually getting rid of bank branches, but still the cooperative bank, under the influence of Peter Marks and the leadership of Neville Richardson, recognized, it thought, that it needed to get scale by taking on even more branches. So it was taking over these Lloyd Bank branches under something called Project Verde. And it was going ahead with it. And then you had the credit rating agency, Moody's, looking into it. And it said, this will not work. Basically, if you look at the figures, they don't show a viable, sustainable business. And at that point, the deal to buy the Lloyds Bank branches collapsed, Project 30 collapsed, but really, at that point on, so did the Co-op Bank, and it had to be rescued itself, and it got significant input from other organizations, from hedge funds who took over a significant share, and it was a decline, and basically at that point, the Co-op Bank was sunk. I should just say before I finish, Tiziana, there were two other elements that brought down the bank, because it wasn't just that. Those are the essential elements, but there are two other things. One was the IT system, and another was the mis-selling of personal protection insurance. Let's just deal with that first. Lloyd's also got very badly damaged by mis-selling payment protection insurance, and that was basically a massive consumer scandal where banks would make easy money, and so did a lot of the retail companies, by selling insurance policy. Got massive profits, margins on the insurance that they were selling, and eventually it was found that basically they shouldn't have been mis-selling these insurance policies, because they were selling them, for example, to people like me who are self-employed, who couldn't possibly claim. I wasn't actually buying one, but I'm just saying, if I had bought one, it would have been mis-selling because I wouldn't have been able to claim on it. Certainly, if you had a pre-existing health condition, you wouldn't have been able to claim on it. So there was mis-selling. You have to ask yourself, the Co-op Bank, an ethical bank, selling itself as an ethical bank, why was it mis-selling payment protection insurance? So that's another question, and it had to pay out hundreds of millions in compensation for having mis-sold those insurance policies. And the other element, and this goes back to the strategic stupidity of the bank, was the IT system. It had to actually spend hundreds of millions of pounds in replacing its IT system. Now, if you go back to before Britannia, it had just invested in a new IT system, and it thought it was top of the range, it was great. And then it merged with Britannia, which made its IT system out of date because it couldn't cope with the mortgage selling. So you have to ask yourself, why did it have an IT system that wouldn't work when it had the merger? And then with the with Project Verde. Again, it had an IT system that wouldn't work. And then you had the fact that it was recognized that actually it was breaking aspects of the law by having a merged computer system with the cooperative group. The ultimate thing is that basically, because of strategic errors, it had to spend hundreds of millions on a new IT system. So you take those three things together, and what you've got is a collection of strategic errors that came about really as much as anything because you had a dominant chief executive who was acting as a shadow director of the bank and without sufficient challenge from the directors. So that is the very sad story of why the cooperative bank got into so much trouble and is no longer any part of the mutual movement, even though it still calls itself the cooperative bank.